Trade recap. I'm going to go over this quickly because this is the second time I'm recording this. I did not have the audio on last time. So let's go over this. So this was my trade yesterday. Yes, it doesn't look clean, so I'm going to go over it and I'm going to explain it to you guys. So this was yesterday. We had CPI. CPI gave us this nice imbalance. And so what do we know about imbalances? We want a liquidity sweep happening at that imbalance. So my bias was fully bullish. The reason why, if we look at the daily time frame, we see that this candle over here, this is Monday, this is Tuesday, this is Wednesday. Here on Monday, we see that we swept liquidity. All this liquidity here, as well as the previous day here. And so the easiest way to determine daily bias is if we close or if we sweep the low or the high of the previous day. So we swept the low, and so this gives us a bullish bias. Because why we didn't close over the day prior. And so the rest of the week was looking pretty bullish to me. Check on the 4 hour. Most definitely you can see that we are rejecting the high time frame. We are sweeping the low of the previous day, and we are showing signs of a bullish trend. So for bullish, we are only looking for buys. And so, as I said, after CPI, price taps into that large fair value gap that's left behind. And so what we're waiting for, we're waiting for a liquidity sweep. So we're going down into the lower time frames, into the 1 minute. We're waiting for our liquidity sweep. And so if we play this out, you can see we get our sweep right there. Sweep of liquidity, rejecting a high time frame confluence. And so what do we look for? Now we look for our entry model to show up. And so far I've taught you guys 2 strategies, and that is number 1, the inverse fair value gap entry. In other words, the double tap strategy. We spot our inverse fair value gap right there, and we enter on the candle that closes over the inverse fair value gap. You can see right here. And so where would our targets be? Our targets would be these highs. Well, first this immediate high, these smaller highs, but more importantly, this high right here. We don't even need these smaller ones. And then we look on the hourly. We've got highs right here and here, here and here. So those were the targets I was looking for. So you can see, if we go back to our setup, that would have been the ideal entry. But if you missed it like I did, our second strategy, which is the triple S strategy, is where we wait for a market structure shift and a tap into a fair value gap. So do you see our market structure shift? Yes, this is our market structure shift. I'm going to make that a blue dashed line over there. You can see that's our market structure shift. And then our first fair value gap that we get is this over here. And so that was my entry, seeing that fair value gap getting tapped into and rejected with this candle. That's when I entered. around here. You can see I had a pretty wide stop loss, and that was okay with me. I was only risking about 1%. I was following my rules, so I was pretty happy with risking that amount and keeping my stop loss fairly wide for any sort of price action noise. But the best way to enter with this is to have your stop loss just under that fair value gap or the candle that made that gap, and you would have had a better risk to reward ratio. But for me, in my case, I had my stop loss down here. And so you can see when price plays out, we reach some of our targets, but not the target that I was initially looking for. Why? Because I was targeting a 2-to-1 ratio. Very standard practice for this type of strategy. And if we use our standard deviation tool to project our targets, you can see that 2-to-1 was sitting actually up here, and that's where I was definitely aiming for. We're aiming for this 4-hour fair value gap. You can see that this large fair value gap on the 4-hour was where I thought price was ultimately going to target. And so let's just add that target there. You can see that lines up nicely with my 2 to 2.5 standard deviations. That's where I was targeting. And it lined up nicely with my 1 to 2 risk to reward. So you can see the reason why I took this trade and where I put my risk and my targets. So then what happened with this trade? Let me show you. If we look on TradingView, you can see that I had my stop loss ultimately pushed up until this area here. And the reason for that is I was spending too long in this trade, right? The key to improving this type of trade is timing and taking the profits where you can. So how can I improve on this trade? Well, we could have had a better entry first of all. That inverse fair value gap entry would have been great. That's our first lesson. Otherwise, there's nothing wrong with entering this way. When entering like this with the fair value gap entry, you'd want to have the stop loss much closer to home because you want to have that ideal risk to reward. You don't want to over risk. But if you're not sure, rather have a wide stop loss but risk a lesser amount. Okay, so if I had my stop loss up here, I would risk my usual 1%. So this would be maybe a 5-lot trade. But if I had my stop loss down here, I will still risk 1% but have a 1-lot trade. So I'm changing my trade size to accommodate my stop loss and my risk. And that is how you manage your risk and keep your trading consistent. But let me show you the secret in this one trade, the secret to all of ICT. You can find these setups on any given day as long as it presents itself. Every ICT concept can be applied after a liquidity sweep. So just making sure that you have a high time frame rejection where you find your liquidity sweep, and then from there apply your entry model. Whether you want to enter on this order block right here, whether you want to enter on the fair value gap that I entered off of, whether you want to enter on the inverse fair value gap over here, or if you want to enter on the breaker. You can see that none of these options are wrong. Why? Just look. Just look. I'm going to extend this. Look where we're tapping into later. We're tapping to the breaker. We're tapping into the order block. And what's happening today? We are reaching those targets that I originally had yesterday. Look at that. Trading can be very subjective. Even if you're wrong, you can be right. Even if you're right, you can be wrong. Sometimes it all just depends on timing of the market. So you can see that I could have left this entry overnight, kept it running, made all that profit. Because what? My targets were correct. My entry was correct. Perfectly well done, 100%. So how come it ended up closing up here? Well, that's the next lesson. For these type of strategies, you don't want to stay long in the market. You want to get in the market and out. Take your slice and go. You don't have to stay and try to catch the whole cake. Not that you can't, you can do that. That is also a way to trade. But for me personally, my strategy, I'm looking for my entries during 4:30 to 5:30. That's where the ideal entries are set up. And then I don't want to spend too long in that trade. It's best to take your profits or take partials at these highs or at these targets as price approaches them, and moving your stop loss up, de-risking, and putting your stop loss in profits when it is safe to do so. Because as you can see, just as easily price can turn around just before the target that you want to hit, because why? The market has lost all its momentum and is most likely either going to reverse or try to look for liquidity again to try and reach that profit target later. So you can see you can still have an A+ entry and everything, but if you don't know when to exit, or if you're spending too long in the trade, it's best to take your profits and get out. So that's the lesson for this trade. I'm definitely looking forward to today's trade. Hopefully we can get a much better entry. But you can see the strategy works, guys. Like, this is all that trading is. This is all that ICT is. This is all that I do to trade. It doesn't get more simpler than that. It doesn't need to be complicated. And all of this, I'm showing you guys this for free because everything I learned was for free. You don't have to pay for it. So this is why I'm telling you guys. Liquidity sweep and your entry model, that is all you need. Keep consistent with 1 to 2% risk per session that you're trading. You can see that I do not trade every day. My last trade that I showed here was on the 2nd of January. And that's because I limit myself to high probability days. And also when I look for entries, I limit my window to 4:30 and 5:30 because that's where I find the best setups are formed during this kill zone at market open. And so you see there's structure to this. There's pieces to the puzzle that need to fit together in order to get these quality setups. And it must look like this. Very textbook, very pretty looking. Don't try and look for a setup that isn't there. Don't try to force it, because then you're literally just setting yourself up to fail. And so that's it, guys. Hopefully I can post today's trade maybe tomorrow. Before I forget, I forgot to show you guys my trade. And so this is the trade I took on MetaTrader 5. You can see I entered at that fair value gap right there. As soon as I saw rejection at that fair value gap, I entered. And if I just fast forward, you can see those price lines, the purple lines and the TP line. That's where I was ultimately targeting. And you can see price was not moving in my favor. And in hindsight, seeing that first break of structure to the downside should have been an indicator for me to close my entry, can see I moved my stop loss to break even, and then I moved it up to that low over there. That's where I was prepared to just close my trade. I was spending way too long in this trade. It was like an hour and a half, which is not ideal. So lessons learned from this trade. But yeah, happy trading, guys. Best of luck for the rest of this week, and I'll see you in the next one.